Part I. What is the free cash flow? What is the weighted average cost of capital, and what is free cash flow valuation model? We have seen all of these before. So, for a reminder, the free cash flow model has two parts, right? One is the long-term assets, and then short-term assets. So we take them as a present value, and for a long-term assets we use the formula value of operation free cash flow of next accounting period divided by WACC minus G. So if we have free cash flow of previous accounting period, we can just include growth over here, and this will be same. When we have this value of operation, we can just add short-term assets into that, and we will have a value of form. J, pie chart, leave it, and K is the next numerical portion. Use B and B data and the free cash flow valuation model to answer the following question. What is the estimated value of operations? We have just seen the formula for value of operation, that is free cash flow at year 0, 1 plus G over WACC minus G. So let's get back to data. From here we can see the free cash flow is 24 million, and it has a constant growth rate of 5% and WACC is 11%. So the free cash flow is 24 million, a growth of 5%, WACC is 11% and growth is 5%. By calculating all of these, we will have value of operations equal to 420 million. That is our first part. What is total corporate value? So total corporate value has two parts. One is value of operation plus short-term investments. So value of operation is 420. Let's get back to the data, and we can see marketable securities are 100 million. These are only short-term investments we have. So 100 million. So total corporate value will be 520 million. That is our second part. Third part, what is the estimated intrinsic value of equity? So we have to calculate the estimated intrinsic value of equity. So total corporate value is equal to equity plus debt plus preferred stock So total corporate value is 520 million. Uh, Equity is unknown. We have to calculate it. Plus, if we go back to our question, we can find that we have a debt of 200 million and preferred stock of 50 million. So debt is 200 million plus preferred stock is 50 million. So bring all of these on the other side. We will have equity equal to 270 million. So this is intrinsic value of assets. Fourth portion is what is estimated intrinsic stock price per share. So to calculate stock price, we need total equity value divided by number of shares outstanding. Total equity value is 270 million and the number of outstanding shares we can get from here. A privately held company owned by two brothers, each with 5 billion shares of stock. So there are two brothers, both own 5 billion shares of stock each. So there are total 10 million stocks and the stock price will be $27 per share. Next is part L. So you have just learned that B&B has undertaken a major expansion that will change its expected free cash flow to minus 10 million at year 1, minus 10 million, 20 million at year 2, and 35 million at year 3. After 3 years, free cash flow will grow at a rate of 5%. So if we want to calculate a fourth year, that will be 35 into 1 plus 0.05, and this will be forever from third year onward. No new debt or preferred stock was added. The investment was financed by equity from the owner's stock from the owners. Assume the WACC is unchanged at 11% and there are still 10 million shares of stock outstanding. So first requirement is what is company's horizon value. So what we mean by horizon value, what is value from year 3 onward forever. So to calculate horizon value at third year will be free cash flow at year 3 into 1 plus G divided by WACC minus G. So the free cash flow at year 3 is 35 and growth rate is constant. WACC is 11% and G is 0.05. If we calculate all of this, we will have 612.5. That is the horizon value of operation at year 3. And what is the current value of operation at time 0? So we have to calculate current value of operations. That will be 10 million divided by 1 plus WACC 0.11 at year 1 plus 1 plus 0.11 at year 2 plus 1 plus 0.11 at year 3 and plus 1 plus 0.11 at year 3. So calculate all of these. We'll have 9 million plus 16.23 plus 25.59 and plus from here we'll have 447.85. So add everything up and we will have 498.68 million. That will be the current value of operations. What is the estimated intrinsic value of equity on a price per share basis? So we have total value, total corporate value, that is value of operation 498.68 plus short-term investment. These are 100, so it total make 598.68. Total corporate value is equal to common equity plus preferred equity and debt. So total corporate value is 598.68. Common equity is unknown. Preferred equity is 50 million and debt is 200 million. By solving this equation for equity, we will have 348.68 million. Remember that we still have 10 million shares outstanding, so price of one share will be $38.868. Next, M part, compare and contrast the free cash flow valuation model and dividend growth model. This is just a theoretical. You can find it in the book, what is market multiple analysis. again available in the book. We will jump to the numerical part, which is part O. What is preferred stock? Suppose a share of preferred stock pays a dividend of 2.10 and investor requires a return of 7%. What is estimated value of that preferred stock? Very simple question. We have to just calculate value of preferred stock. So we have a cost of preferred stock formula, that is dividend over current price of the stock. So now we want to calculate the value of preferred stock, and that is actually the price. So rearrange that formula for P naught. We will have debt dividend over return on preferred stock. So dividend is 2.10 and required return for the preferred stock is 7%. Solve this formula and we will have value of preferred stock $30.